It is now my pleasure to introduce Daryl Diamond. Please go ahead.
Thank you, and thanks everyone for taking time to join us today on this discussion of your retirement income blueprint and more specifically how it applies to you. Obviously, you've had a chance to visit the Blueprint website as a result of having exposure to your retirement income blueprint, the book, and or any of the opportunities where we are on media, be it TV or newspaper. So thanks for taking the time. Today's agenda is going to basically focus on the following. We want to start by sharing with you some of the feedback we receive from consumers once they've had an opportunity to read the Blueprint book, discuss throughout the course of the content today some of the differences, distinct differences between the accumulation years and the income years, make reference to the importance of the Blueprint, provide you with an overview of the 6 steps of the Blueprint, a quick discussion at the end of the presentation about our business process, and as mentioned earlier, we've invited you to submit questions via email, and we will get back to you with answers to those questions over the next few days. One of the pieces of feedback we get from consumers is that in discussions with their current advisor, be that an individual or an institution, not always, but in many cases, they say, we try to have this discussion about what is this going to look like when the time comes that we're actually going to start to take income from the assets that we have put together. And quite often the response they get is, don't worry about it, we'll talk about that down the road, or we'll cross that bridge, if you will, when we get there. And that's, in many people's minds, what the picture of the bridge looks like that needs to be crossed. But in reality, as it relates to the differences and the really different art and science that retirement income planning is, this is what the bridge really looks like. So obviously, the more that can be planned and dealt with in advance, the more beneficial it is to the consumer, and ultimately at the time they retire, the better prepared they are. Pardon me, I'm just going to take one slide back here. Some of the other comments we get quite commonly from people who have read the book and are in contact with our office, either through email or on the phone, is that they just seem to be not getting the types of answers, or they're not comfortable with the type of answers that they are looking for as it relates to retirement income planning. Some people have told us that they actually formulate a list of questions as a result of having read the Blueprint book, and find that there are many occasions where an advisor can't provide them with the type of answers that, again, either they need to have or that they feel comfortable with. And rather than read through these point by point, it's just to simply indicate that, again, and this will be repeated many times through this webinar, as it was through the Blueprint book, this period, this transition from the accumulation years to the income years, very different time for people. The other thing that we find from the work that we do, and this is where we have an opportunity to sit down with people and look through on a cursory basis the type of advice or direction they have been given as it relates to retirement income planning, and again, their feedback in terms of their frustrations. But quite often when we look through what has been either suggested or recommended or even put in place, depending on the timing, we find that consumers, for the most part, are basically ineptly advised, underserviced, and in some cases overcharged, and in certain other cases, all three of those things. Well, really, in terms of the retirement income time in someone's life, this is an area where you're trying to make use of your assets in the most efficient manner. So improving any one of those 3 areas, any combination of those areas, or even all of those areas, serves to assist in the objectives of both capital preservation and sustainability of income, both of which are key in the retirement income space. The book, Your Retirement Income Blueprint, is really a compilation of both technical information and our experience of having done this exclusively, worked in the retirement income area exclusively for the last 25 years. And within that work, we have developed strategies and processes specific to retirement income planning. That has distilled down through what you read in the book, into a 6-step plan. And what we are going to do today is just touch on those 6 areas, not in great depth, but in enough detail to make you aware of how the retirement income blueprint affects you. So in doing this, what we have found over 25 years is that the blueprint or the written plan, the same thing, it's just that we call the written plan a blueprint, is really the key or the driving vehicle or document that should direct everything from the point of view of a foundation and a framework and a course of action. So in our service offering within our organization, the plan itself is custom tailored to the client's situation. And as we'll talk about being one of the key differences in the retirement income space from the accumulation space, everything in the retirement income space is specific to the situation. And what I mean by that is that every client situation is different, both in terms of objectives or assets or entitlements and circumstances. So there really are very few things that are universally applied in terms of a direction or a course of action. And that again emphasizes one of the big differences in the accumulation years versus the income years. Now within an actual blueprint or a plan, there's 2 parts to it. The first part is really what we call the narrative. And the narrative follows, as you can see at the top of that graphic, the 6 steps that put together the plan. And it does it in order, and it's customized or tailored to the specifics of the individual or couple's situation. The second part of the actual blueprint are the computer illustrations. So what the first part, the narrative, actually does is serves to explain all of the illustrations that happen within the detailed computer projections. So we found that by combining both the technical side with the discussion or the narrative side, it provides a document that people can understand very completely, comfortably, and also outlines rationale for recommendations in the course of direction that's been put forward within the plan or the blueprint. So the first question that the blueprint or the plan will answer is probably the most common one. And that is, can I afford to retire? Well, yes you can if you have sufficient assets and benefits, as you can see there, to create the income you need that will provide you with the lifestyle you want, and that can be sustained throughout your retirement. So, can I retire based on what I wish to do, what the assets I have will generate as far as cash flow? That's a pretty important question to answer. Obviously, you don't want to retire too soon, where perhaps there aren't sufficient assets to provide you with the lifestyle you want. And of course we're using assumptions, of course we're using projections throughout these plans, but that's the key thing that is shown to us and actually will reflect itself in step 6, which measures the net worth of the income producing assets if recommendations and assumptions are carried forward. The other thing that the blueprint does is this. It allows us to illustrate to our clients not only the processes that have been developed over years, but allows us to also show employing proven strategies, allows us to define and recommend a course of action specific to their situation. And as it says in the points that follow here, there are so many moving parts, and it becomes a very complicated process. Again, one situation may be more complicated than another, but it really coordinates everything. And we're going from situations where there's perhaps 1 or 2 incomes per household, if there's a couple, to where there may be 6 or 7 different income streams per person in a household, and that's a big change. The other thing the blueprint does is it allows us to illustrate how current inefficiencies can be improved. What do we mean by inefficiencies? Just improvements. This is a partial list, and certainly some of the key things, where we're talking about making best use of the assets people have taken a lifetime to accumulate. And these are the assets that are going to generate the income that's required in retirement. Now, a lot of times we'll see recommendations that come through, or we'll find people who have already retired and have had certain things in place, or recommended that as a course of action, that we may look at and say, you know, we don't think that's necessarily the most efficient way to do it. We can show through the blueprint how we would approach it and then compare the two outcomes. And we found that to be very beneficial as it relates to helping people make, as it says at the top of that slide, more efficient use of the assets they've taken a lifetime to accumulate. The analogy I always use in talking about making things more efficient is this. If I'm flying from Winnipeg to Toronto, my travel agent could say, well, look, here's how you should go. Winnipeg to Vancouver to Hong Kong to London to Toronto. That advice, or that recommendation, when you think about it, it's correct. It's not incorrect. It is correct. That is, in fact, how I could get to Toronto from Winnipeg. It's just that it's not as efficient or effective cost saving as it would be to go the other direction from Winnipeg to Toronto. So there are things that we see where people have had recommendations made to them by other advisors or institutions that aren't necessarily incorrect, just that they're not as efficient as they might otherwise be. And by efficient, we mean throughout retirement. So, again, talking about differences between accumulation years and income years, often people will say, okay, I get it. There is this difference. It's like golf, where the front 9 is the accumulation period of time, and the back 9 of golf is where I'm taking my income from the assets I've saved. And we say that analogy is partially true, but there's more of a difference than front 9, back 9. Let's keep that front 9 part where that has been the accumulation years. So we built up the assets that are going to generate our retirement income. We go into the clubhouse after that front 9, having saved all of these assets, and when we're about to start taking our income, you don't step on the 10th tee box. What happens is this. You step onto a freshly flooded sheet of ice in an arena. That's how different it is between the accumulation years and the income years. So what we believe is extremely helpful to clients that we work with is the fact that we have experience doing this over and over again. It's a different time. It is far more complicated than putting money away into savings. And there are a lot of people in our industry and a lot of very good institutions in our industry that are very helpful to consumers in helping them accumulate the assets they're going to need to fund their retirement income. But when the time comes to actually structure that income, what we have found is that there aren't a lot of advisors who are proficient in this area. And by proficient, I mean able to deliver all of the key efficiencies that can be obtained in this space we call retirement income planning. The other thing that's very key is this. It's the one time where people really need specific advice. There is not a lot of rules that apply to everybody across the board, and that's what makes this area challenging both to advisors, because every situation is different, also to consumers. This is not an area where you can go to the internet and say, what should I do? Because you're working with one, perhaps, income stream at a time. You may look up information on Canada Pension, and there may be things that you find on the internet as far as an outlining of different options, but which ones apply to you? Which ones are better for you to employ given all of the other assets and income streams you may have? And that's why you can't do this over the internet. There's too many variables that come into play. So when we talk about custom-tailored advice and planning and execution, that's why this area is so different from the accumulation years. In fact, the answer to most questions pertaining to retirement income planning is it depends. There are just too many variables, too many extraneous factors, and what might be a perfect course of action for someone given a set number of circumstances in their situation may be thrown off course if there's one other variable that enters into it that wasn't considered previously. And keep in mind, too, that things do change through retirement. So this is an ongoing process, as we've talked about throughout the Blueprint book. It's not simply an event. Touching on the six steps, first, of course, is just assessing where you are in your current life stage. Are you whether it's an individual we're talking to or a couple, are you like the people on the far left-hand side where you're just about to enter into retirement in 2 or 3 years? Are you like the people in the middle where perhaps you've been retired for 10 or 15 years? Or are you like the gentleman at the bottom corner who was married but just lost his spouse who he's been married to for 45 years? All of these are different life stages. They all have different reference points, different data points. And the first step, and it's a simple one, is just assessing where you are in the current spectrum of what we would call a retirement life cycle by finding out and defining what stage you're at. The next step really has to do with defining what it is you wish to do in retirement. When you look at that list of points, there are a few that are really specific to a financial question, but all of them have a financial implication. Particularly, how do you plan to spend your time? What are the things you wish to do? What are your lifestyle and fulfillment goals? It's important to know that because if we're setting up a plan that is going to allow people to have a fulfilling retirement, it's key to know what things you would like to pursue or do now that you have the time to do them. That doesn't mean you're going to have all the answers at the time you retire in terms of everything you wish to do, but to get people starting to think through this question is very, very important. Because we also want to cost it into the cash flow of what they're going to need through retirement as far as income goes. It's not really that valid to say, I'd like to do this, this, and this, and then not plan to be able to fund it. So our view is always from the point of how is it that assets can be properly invested unless we know the cash flow that's going to be needed, and we don't know the full cash flow that's going to be needed until we have helped people understand what it is they wish to do. So we may have a couple that says in the morning during a meeting, well, here's what we'd like to do in our first year of retirement. She says, I would like to learn to speak Spanish. And he says, I would like to learn how to play guitar. That's fine. Meet a couple in the afternoon, same objective. She says, I would like to learn how to speak Spanish. He says, I would like to learn how to play guitar, but this couple wants to do that in Spain. Well, that's a very different pricing and costing issue. So why it is key to help people begin to and eventually evolve and refine these lifestyle objectives is we want to help them be able to fund the cash flow they need to do the things they want to do. That's really what retirement is all about. It's also key to know that retirement's not just simply one phase. Someone doesn't retire at age 58 and then pass away at age 92 and it's nice and streamlined and uniform and uncomplicated in between. Retirement, rather than being one phase, is really a series of stages. And the stages are defined, as I talked about in the blueprint book, by these, what we refer to as life-altering events. This is not the full list, but it's certainly the key ones, that when one of these things arises, what follows will never be the same, not the same as it was before the occurrence of one of these events. When you look at this list, a couple of things stand out. First of all, they usually either involve family or health, and in a lot of cases both. The second thing is when you look through this list, it's not that someone will go through perhaps one or two. They will go through one of any number of these throughout their retirement. So each time one of these life-altering events occurs, one of the key things a blueprint does is allow for accommodating the change that will follow in a much more orderly and effective fashion. So at the end of this step, to summarize it, what we believe is key, and keeping in mind that people are not going to have the same level of health all the way through their retirement, define what you would like to do. Prioritize those things are important, and let's make sure we fund them and allow people to do them. If we can merge your time through retirement with your money, we have found that that results in a fulfilling experience. And this is not a rehearsal. We don't get to go through retirement a few times. We're going through this once. So why wouldn't we take every step to possibly make it as fulfilling an experience as we can? So with our step 1 and step 2 now completed, we know the spot we're at in our retirement life cycle in step 1. We know our objectives, and we've costed them out. That leads us to step 3, which are the financial goals and priorities. In terms of determining the amount of cash flow people will want or need through retirement, we believe it should be broken down into two specific categories. First of all, basic needs. Those things that have to be there come heck or high water in terms of, by being there, I mean have to be funded through all sorts of market cycles and different contingent situations that may arise. The more discretionary side, the lifestyle side, we have some flexibility there. We have some variability in terms of how things can be handled if there's a disruption in markets or investment returns. And so there we have a little bit of latitude as opposed to where the needs have to be met. That's why we like to distinguish them. The other question that enters into the equation is how much of this income need, this cash flow need, should be guaranteed? And what are the best ways to go about doing that? Through our experience of doing this over 25 years, and as we stated in the Blueprint book, what we've come to realize is that people in retirement don't need the same level of inflation-adjusted income all the way through the years that they're retired. And the main reason for that is that there's a difference between life expectancy and years of good health. Simply stated, someone age 85 doesn't spend money in the same way someone age 65 does. And we always suggest to people, look at your parents as kind of a guide in that respect. And while there may be the odd exception to the rule, by and large, people's spending curve tends to plateau as they get out into their late 70s, early 80s. We try to reflect that in the planning work we do with the following approach and the following chart. Again, this is something you will have seen in the Blueprint book. And all we do is adjust the amount of cash flow at the time an individual or the younger person in a couple is age 75, and we drop the projected required cash flow by about 25%, having indexed it up to that point and then indexing it after the fact. By and large, what we're saying is, although people don't need a fully inflation-adjusted income from age 65 to 95, we do have to take into account inflation. And we do have to take into account the fact that, certainly from experience, that if there are inflationary issues in the latter years, meaning as people are moving into their 80s, a lot of that has to do with health-related costs versus going on extended vacations. So we do want to make sure we've covered off those contingencies in one way, shape, form, or another. We talk about that in the chapter entitled Insuring Your Building within the Blueprint book. So if we now have calculated what we're going to do with our time in retirement, we've attached a cost or funding amount to that. We've defined the amount of cash flow we need in step 3. That takes us to putting the cash flow together, which is step 4. We refer to this as layering income. Why? Because we like to have a visual in the mind of our clients that we are stacking one form of income on top of another to get ultimately to the cash flow after tax that they need. And again, you may find in your own situation you have any one of a number of these different sources of income to provide the cash flow that will ultimately be your retirement income. And again, it varies by situation, it varies by couple, it varies in dollar amounts, but that is why everything has to be custom tailored. So from our experience, there are some considerations that we call variables that relate to layering income. We've defined our cash flow objective, so we know, if you will, the target we're trying to reach. But everyone has different income sources that are available. The questions that come up mostly from people with whom we are first chatting about this issue is, well, what should I take income from first? Should I start my Canada pension? Should I defer it? I get more if I leave it. I get less if I take it early. There may be different pension options if they're in a pension plan that they have to consider. But there are so many variables that come into play as it relates to layering income. And I think among the issues of efficiency, we need to know what the value of the registered accounts are versus the non-registered. What is the age of the individual or the ages of the people in the couple when we're starting this? And key to this whole process of efficiency is which assets are best to use and which assets are best to defer. Again, that answer is, it depends on a whole bunch of different factors, some of which are listed here. So layering income is really a process within the six-step process, so to speak, and there are actually 6 points, although you only see 4 on this slide. We're deferring the other 2 for a moment because I want to take some time to discuss number 4 in more detail. It's really where the rubber hits the road in terms of efficient use of assets to create retirement income. Our experience has taught us that it is more beneficial for clients to use the least flexible and least tax-efficient income sources first in the lower tax brackets. And we'll give you an example of that in just a moment. But again, what we'd like to do is establish the foundation of the income we're creating with the least tax-efficient sources at the lowest tax brackets. That leads to the 4th point, which we call putting the least amount of strain on an asset to deliver the next dollar to spend. And why I separated the last 2 points is that I want to stop for a moment on this 4th point and really put this into some specifics. This is just using Manitoba tax rates for 2015. And what you have on this chart, there are the 4 federal tax brackets, and then in italics at 31,000 and at 67,000 are the intervening provincial brackets. Now, almost all provinces and territories have these intervening brackets to the federal brackets, and really, put it very, very simply, very bluntly, and very truthfully, it's a mechanism that allows the provinces and territories to collect more tax. That's really as simple as it is. So if I can just focus your attention on that first, the start of the 2nd federal tax bracket, which is $44,701. In Manitoba, if we have income that's fully taxable, and that could be from a pension, Canada Pension Plan, OAS, a formal RIF payment or LIF payment, anything that's fully taxable, interest on a non-registered investment account, foreign dividends, we would call that fully taxable income. If my income is below $44,701, it takes either $1.39 or $1.35, depending on the level of income, to get $1 to spend after tax. Once I cross over that first federal bracket to the 2nd federal bracket at $44,701, you can see that it takes a jump up to about $1.54 to get $1 after tax. So that's about a 30, 35%, 40% increase in tax payable to get that same $1 after tax. If I have income over $44,701 that's in the form of eligible dividends, capital gains, or money coming from either a return of capital arrangement or a TFSA, it takes $1.19, $1.21, or $1 respectively to get $1 after tax. So when we talk about putting the least amount of strain on an asset to deliver $1 after tax, this is what we're making reference to. And income amounts, income sources will change year to year, and that's why, again, coming back to this issue of it's a process rather than an event, while the blueprint is a foundation and a framework for a course of action, the relationship that we have to have from an advisory side has to deal with our clients on a minimum face-to-face of once a year to make sure we're making this all flow through in the most efficient way that we possibly can. And in doing so, not needlessly lose government tax credits or old age security payments on a basis, as I say, that's needless. And that just has to do with being very careful how we structure the income over the course of retirement. And we'll talk about that more in just a second. Aside from the different tax brackets that we're dealing with, there are also other thresholds in the form of, as we said before, personal amount exemptions that deal with tax credits specific to people age 65 and over, as you see on this slide. So if someone in retirement is age 65 and over and their taxable income, doesn't mean their net cash flow, but their taxable income is under $35,486, that's the third line from the bottom, they're entitled to the full age amount, which is a tax credit. That in 2015 works out to $7,033. Going back to the top of this chart, you combine that with the personal amount and the total exemption for a person before they would start to pay any tax at all. From a federal perspective, is $18,360. If they have income that's eligible for the pension credit, we're actually over $20,000 approximately before the person is paying their first dollar in tax. So the preservation of credits and entitlements is important, Again, it helps with capital preservation, which of course distills out to sustainability of income. Coming back to one of the original premises that was made, which is true and correct, there are a lot of moving parts at this point in time, and there are a lot of considerations to making this work in the most efficient manner. So as part of layering income, one of the things that we do try to do is create the cash flow people need as efficiently as we possibly can. But there's another consideration to this. It's not just simply a question of making it work efficiently today. And again, our strategies are going to vary depending on what amounts of registered capital we have to work with, non-registered capital, what other pensions or government entitlements people may have. But we need to look at how to make it work tax efficiently right now, today, how the decisions we make in terms of which assets to use to create income will impact how things will flow in the future in terms of a tax scenario, how this will transition to a survivor, if we're dealing with a couple at the time of retirement, and ultimately how the residual income-producing assets will transition to the estate efficiently. If you go back to the blueprint book itself, I think every third word is efficient, and that's because it's so important to capital preservation and sustainability of income in a retirement scenario. And it's one of the things that we know in many cases is not being done effectively enough or as effectively as it could be. And there are great improvements that could be made in most situations that we initially encountered. The last two steps in the layering of income, obviously looking for income and or asset splitting opportunities, and number 6, determining which assets are best to use and which are best to defer. In our biased view, this is how we like to see the layering of income take place. Of course, it's contingent upon when certain income streams are available. If I have someone retiring at age 63, well, their OAS is not available for at least 2 years. They may have a deferred pension benefit that doesn't start until 65, and so on and so forth. But as these different income streams are available, going from bottom to top, this is how we like to see them employed. Least tax efficient, least flexible sources of income first. And as much as this may be a general illustration, again, remember, it depends on the specifics of the situation. So we've determined what we're going to do. We've determined, as a retiree, we've determined what people are going to do. I should phrase it that way. And that's fine. We know what they're going to do to make it a fulfilling retirement. We've costed that into their cash flow needs. We've determined where we're going to draw that income from in terms of which assets or benefits. And that brings us to step 5, aligning your investments. I made a comment before that I don't think it's appropriate to be talking to people in retirement about here's how you should invest your money before we really know how much they're going to need to spend, which we don't know until we've got the lifestyle planning objectives pretty much defined and costed. So step 5, appropriately out of 6, is where we start to talk about the investments. And this is different from the approach that we see in a lot of other organizations where they want to talk about the investments first, and that's where the focus is. They are important, but the investments need to align to the blueprint. Keep in mind that a portfolio on its own is not a plan, and it's a plan that is the foundation for a course of action. So we believe that appropriately, step 5 out of 6 is where we first start to talk about the investments themselves. And in the current environment we're in, there are some complications that we refer to as investment dilemmas for most people who are operating out there without some kind of formal plan and strategy and course of action in place. Capital preservation is always critical. So is sustainability of income in retirement. It's a different scenario today with the absence in most cases of formal pension plans that people are creating their cash flow from their own savings. That's a big difference from when you're having a paycheck deposited to your bank account. We've seen extremely high rates of taxation on guaranteed investments such as GICs, and the rates are historically low. So it's a difficult and complicated time to be working strictly with GICs unless you have a pretty large accumulation of wealth. people still remember what happened in 2008 and 2009. If they were taking retirement income at that time, it had even more of an impact in terms of their psyche and their level of comfort. If you were going through your accumulation years in 2008 and 2009, you know there was still a huge impact if you were in a variable portfolio that involved equities. But take my word for it that your experience, if you were still in the accumulation years, is nowhere as impactful as it is if you were taking income at the same time markets fell to the extent they did in 08 and 09. No, we're not going on record as calling for a repeat of that, but it is to say that there is a real investment dilemma for retirees if they have a reluctance to look at variable assets at a time where interest rates are so darn low. We also have seen since really last August of 2014 that we're getting back into that environment where there's a lot of swing in the markets, the equity markets, in terms of volatility. And we may see that when we get to a point that interest rates start to move up, which will of course affect the fixed income markets. So how to go about things? How do we structure a portfolio specific to a retirement income scenario? Well, of course, the answer is it depends on what we need to create and what the cash flow requirements are and what assets we are dealing with. What we do know for a fact is that it will be different in terms of the actual specifics for every client that we're working with, because nobody's situation is the same as someone else's. But what we know is that this is a different time from accumulation. Normally when we meet people, we may not have made an RSP contribution for them. They may be done their saving years, and the investments that they have were likely set up for an accumulation scenario. What we have found works most efficiently is where the investments are aligned with the blueprint, not the other way around. It's one of the reasons why we don't write a plan on a fee-for-service basis for someone and hand it off to them and say, here you go, good luck, and may the force be with you. It really is a situation where, done properly, once the blueprint, the plan is set up, taking into account all the specifics for the client situation, now we can align the investments with the blueprint so that ultimately we're able to execute the plan over time. Keep in mind, too, that there are, as it suggests here, different tools and strategies that people in a lot of cases wouldn't have thought of employing during the accumulation years. They're unique to the retirement income space and very efficient at doing so. So aside from just a portfolio, the question is, or the point is, we want to have a portfolio that is aligned with the blueprint and has the opportunity to consider certain tools and strategies specific to delivering income versus accumulation. Also, from our experience, structures, strategies, portfolios, and managers that do a superior job at being able to weather downturns in the market. On the top right-hand corner of this chart, in the little box that says bull and bear facts, it says that the average decline in the stock market is about 28%. You can see this chart, and by the way, this is unabashedly a chart that is used for marketing purposes, not for us in the way it was intended. Really what this is designed to show is that for investors, the vast majority of the time, you're above that line in periods of good growth, good economic and stock market performance, and those little guys at the bottom, those little divots that you see below the line, that's just the market downturn. So if you're invested in the market for the long term, you can expect that the vast majority of the time you will be in positive territory and things are going to look good over time. And that's all fine. That's what the intent of this marketing piece is for, but we look at it in exactly the opposite way. The focus for us are those little lines below the horizon that talk about times where markets are down. Again, different in the income years where you're having a decline in market value at the same time you're taking income out. That's a double drawdown, and that can have an extremely large impact, as we talk about in detail in the Blueprint book, on the assets that you have to produce your income. So when we're meeting with someone for the first time and they're assessing the value of what our counsel, our advice, our planning, our investment strategies are, one of the questions we'll ask them, if they're not clients of ours, is this. What is the strategy that is currently in place for creating your income when markets, and subsequently the value of your accounts, are down? Now, on average, and let's just use a really simple number here, on average, if, as we saw on the previous slide, the downturn on the equity side is about 28%. Even if your accounts are split 50-50, 50% equity, 50% fixed income, that's a 14% drop. And you can take the aggregate of your invested wealth to produce your retirement income and apply the numbers. But if I've got $1 million, that's a $140,000 drop in account value, plus I'm taking income out at the same time to fund my retirement. So it's a question we ask because it's a critical question that people need to be answering if they don't have an answer for it. And it's part and parcel of the art and science of creating retirement income. And that is, that there are strategies to not necessarily prevent account values from going down. We don't have that magic at our disposal. But what are the strategies we use to buffer the impact of that to create income without selling securities? There's a number of different strategies. Again, developed over a number of years, specific to the retirement income space. And a lot of times we'll ask people this question as it relates to their current investment advisors, and they don't have an answer for it. And in a lot of cases, neither do their investment advisors. Some may, and that's fine. That's a situation where you may be working with someone right now who is proficient in this area. And that's one of the telltale signs, I think, as it relates to evaluating your current advisory relationship. When you're working, building up those assets that are going to spin your retirement income, you can have investments at any one of a number of places. You may not have brilliant asset allocation, you may have duplication, but there's not really a significant downside other than that. When the time comes, however, that you're going to start to position things to take retirement income, say 2 or 3 years before actually receiving the first check, or you're actually in retirement taking income, there's great efficiency to consolidating all of your assets under the guidance and direction of not only one blueprint but one advisor. That doesn't mean necessarily one and one only investment or investment strategy. We're just talking about consolidating things so that you have, as it says there, a greater opportunity for better tax efficiency. You need to, if you will, have one person overseeing this so that all the different sources of income are working efficiently, and really more than anything else, just doing it on a basis where there is tax optimization, again, on a year-to-year basis. Step 6, this is just a simple graphic, and we always show this at the end of the blueprint that we do in the computer illustration. And it tells two tales. First of all, in this scenario, we have a situation where someone has retired. Yes, they have sufficient assets to do what they wish to do. When we talk about the impact on net worth and assessing that as a sixth step, what we don't include is the house, the car, the boat, the cottage, any of that. This is strictly the net worth of the assets that, in this case, this couple has to produce the income that they want throughout retirement. And you can see that they have ample income, and even using conservative rates of return in the projections, actually see a scenario where the value of the assets on a nominal basis increase over the time horizon that's shown. If all of those lines go down to 0 at age 82, well, they wouldn't have had sufficient assets to execute, in our opinion, the cash flows they wanted to have to do the things they wanted to do. So any one of a number of things would have had to change, including reduce the level of cash flow needed, not retire as soon as they wished. There's different ways to address that. But in this scenario, and it's a key measure and a key sixth step, this is what is telling us whether or not a person has sufficient assets to do the things they wish to do in retirement. The second thing that it illustrates is this. As you know, if you've read the Blueprint book, one of the things we try to do very efficiently over the time that people are retired is draw down on the least tax-efficient assets in an orderly and smooth way, and at the same time, where we can, defer the non-registered assets. So in this graph, not only is it telling us that these people have sufficient assets to produce the cash flow they want. But you can see that we're drawing down on the lighter shades, the pensions and the registered money, the lighter shades of blue on the top two levels there, and we're actually growing the non-registered and TFSA components of their situation. The strategy in doing this, as we outline in the blueprint book, is far greater efficiency as it relates to survivor income, assuming we have a couple, at the time of retirement, and also transition of the residual assets to the estate at the time that occurs in a much more tax-efficient manner. And this is achieved over time, year-by-year strategy, and being vigilant and opportunistic in terms of how we can morph those fully taxable assets into more tax-efficient, tax-friendly assets. Just a few slides to wrap up the webinar today. This is the retirement income process we employ. We believe that everything is driven by the blueprint, which falls into that first category, competent planning. As we've talked about in step 5 of the 6 steps, the alignment of the investments to the blueprint is absolutely key to the third part, which is efficient execution year over year. Things change. Things will have to be navigated year over year, but that is the benefit of the relationship and the execution of a plan that's been put in place and custom tailored to the objectives of the client. I'm going to take those 3 boxes and sort of, if you will, pull an X-ray machine up to them in just a second. But before I do, quite often we'll meet people and all they are involved in is that second box. They've got someone that's managing investments, period, end of story. That's not right, wrong, good, bad on its own, and they have been very productive during the accumulation years. But this is a time of change. So just to distill down the points within each of these 3 areas in more detail, this is how it really looks. So we may run into people, as I say, that are talking to us for the first time, and they may have somebody managing their money somewhere, and they're paying a certain fee to have that done. That's one part of a very large number of things that have to happen in efficient and effective execution of retirement income. So, yes, they may have someone managing investments now, but is there a strategy in place? Is this aligned to the blueprint? So, in our business model, we are hands-on on the investment side in terms of investment management, in terms of asset usage to basically affect all of the other points that you see in these 3 boxes. That is how we have found it works most efficiently for our clients. It is not to say it is the only way. There are other advisors that may do things differently, and it's not to say that this business model is a fit for everyone looking at the services we provide. But where it is a fit, it works brilliantly. Some of the resulting benefits of working in tandem with us and the services we provide is that it is a year-by-year execution, as we've said. If we can help to reduce income and estate taxes, if we can preserve government benefits and credits and entitlements through the work that we do year to year, over and over again on a large block of capital, otherwise known as your income-producing assets, that adds up to a very large dollar amount at the end of the day. So there are strategies, there are structures that we use to facilitate this, and they are unique to the retirement income space, and they're also things that we have used over and over again. So it's very easy for us to put forward to you the premise, having done this for 25 years, that we not only have a process, but we have strategies and tools that have been proven over the time we've been using them. That brings us to the end of the time we have together. We invite you to send any emails you may have to us. Give us a few days to get back to you on questions. If they're really involved questions, we may either ask you for more information or we may ask if we can call you directly to answer them, but we will welcome the opportunity to do that as a thank you for having taken the time to attend this today. We are based in Winnipeg. We have clients from Comox, BC to St. John's, Newfoundland. We also have associates who are what we call accredited in the blueprint process and can deliver services to you in several of the major Canadian centers, and we'd be happy to talk to you about that as well. This webinar will remain up on the Boomers Blueprint site, and we welcome you to revisit it at your leisure. Also, if you have found this to be beneficial, and hopefully you have, we would invite you to suggest it to others who may want to have the opportunity to find out more detail, not only about the mechanics of the process of the blueprint, but how it applies to them and the services we provide. Once again, we would like to thank you for taking the time to attend, and with that, we will bring this webinar to an end, with the notice that we will be providing other content and webinars on a basis that is yet to be determined, but there will be future sessions, and we welcome your attendance. Thanks very much.